Well, good morning, everyone. I'm gonna begin discussing partnership. Part of this, you guys were introduced in chapter 13, especially what was related to the partner's basis. So I'm just gonna get started. The first thing that we're gonna be looking at is partnership formation. So every time that a shareholder or partnership forms an entity, they could be a tax exposure. In relationship to the partnership, there's actually no gain or loss on the formation of a partnership. So if the partner contributes cash or if the partner contributes property, there will be no gain or loss. You have to pay attention to just some terminology here. Pay attention to outside basis versus inside basis. So outside basis relates to the partner's basis in the partnership. So I think we looked at that in chapter 13. The inside basis relates to the the partnership's basis. Most of the time, these are the same. The inside basis usually equals the outside basis. The beginning basis of the to the partnership is usually the basis of the assets contributed. So it's just gonna kind of carry on whatever the partner's basis was on that asset, whatever the partner's holding period was for that asset, especially if it's section 1231. So we have some example or an example here, actually a couple of examples. We have Bart and Alan. They are 50-50 partners in this LLC. And we have Bart's basis of the assets that he contributed and the fair market value, and Alan's basis and fair market value. Now, when we said basis, what we mean is the adjusted basis, right? So that will be, if this is a depreciable asset, then it will be the cost less any accumulated depreciation. So that's what we mean by basis. So just just to remember, recall our instruction for chapter 7 when we were looking at assets. That's what we mean for adjusted basis. So for financial reporting purposes, we would actually use at the partnership level, we would use the fair market value to record assets. But for tax purposes, we use the basis. Okay, so we have, this is the tax basis, and the fair market value will be what would be reported for financial reporting purposes. So what we're looking at here, this is the assets to, the basis to each partner, and then we have the basis, tax basis to the partnership. So this is a tax basis balance sheet. This is not a balance sheet for for third-party users. This is a tax basis. So the purpose of this is to show you that the basis, for example, of Bart for this equipment was 35,000, and so the partnership is going to continue carrying this 35,000 as the initial basis and will continue to depreciate where the individual left off. Okay, so we talked about the holding period will be the same as the partner, especially for section 1231 or capital assets. Now, we did say that upon formation, any contributions of cash or assets will not trigger a tax for the partner. However, there's some times where the partner is contributing their know-how, right? Their knowledge or maybe their customer base. And so they are basically getting an interest in exchange for those services that they're performing. And so in this case, this contribution of services, because they're receiving an interest in the partnership, is going to be considered ordinary income, and the partner will be subject to taxation. If the partner, or I'm sorry, if the partnership were to assume any liability, so I contributed equipment, but the equipment, I took out a loan for this equipment, and the partnership is going to assume that liability, then I'm going to have to decrease my basis by the amount of the liability assumption or the liability release. So here's another example. We have Russell and Kevin and David form a partnership. Russell and Kevin are wealthy investors. David is an expert constructor. So we have basically that David is going to provide services to the partnership in exchange for a 40% interest in the partnership. We have the basis and fair market value of the assets that Russell and Kevin are contributing. So in order to assess the value of David's services and be taxed on this as ordinary income, we're looking at the fair market value of the assets contributed in this case. And so the total fair market value is $600,000 multiplied by the 40% interest that David is to receive in exchange. And so the amount of ordinary income that he'll have to report and pay taxes on is $240,000. So this is sort of a disadvantage for a partner who is exchanging services for an interest in a partnership, because they're going to have to pay taxes up front without receiving any cash. We have, in this example, we have an example for release of liability. So we have a partnership with 4 partners. We have their respective beginning basis, and we were told that Angie contributed a building with a fair market value of $300,000 and a basis of $160,000. So we know that her basis will be credited for the $160,000. The basis of the property that she contributed. However, this property has a mortgage of $100,000, which the partnership is going to take over. Okay, so Angie will no longer be responsible for this debt. And because of that, then this is going to reduce her liability. The other thing is that the basis, or I'm sorry, the loan is a qualified recourse loan because this is guaranteed by it's a mortgage loan. It's guaranteed by real estate property, and therefore is going to increase the partner's basis. In this case, they all hold a 25% interest, so that's the allocation. So that's gonna, so initially we have the basis of the asset that Angie contributed that increased her basis. 1/4 of the mortgage loan is added to her basis, but we are subtracting the $100,000 because the partnership assumed this liability. She's no longer responsible for that. Now, in doing these calculations, if we look at the next example, everything, all the facts remain the same, except that the basis of the building is now $45,000. So we add 1/4 of the $100,000 mortgage. And so we have an excess basis here because the we cannot go on to generating a negative basis for the partner when there's a mortgage attached to the property. Then we're going to have to recognize a gain on this loss, on this negative basis. So Angie will have to pay taxes on this gain. Okay, I'm going to skip over through the concept checks. You can do that on your own time. The PowerPoints are available in Moodle. Excuse me. The next one is the ordinary income or loss and the separately stated items that are passed through to the partner. If we recall, we said that partnerships are a flow-through entity. So the partnership itself does not pay taxes, but it's going to split its net income and have each partner pay their share of the taxes on that income based on their marginal tax brackets. So how exactly is this done? Let me just, okay, I'm looking for, there we go. So here we have that what is going to be reported, the items that are going to be reported and used in calculating ordinary income or loss. So it's just like, the Schedule C that you looked at. We have our gross profit, we deduct our expenses, and then we calculate ordinary income. So the kind of items that we are not going to include in this ordinary income or loss calculation are stated here separately because they're going to be separately reported on the Schedule K1 to the partner. Okay, so these are not included in calculating the ordinary income or loss. Okay, so going back to where we were at. Okay, so another point of discussion is the guaranteed payments. I think we talked about this last time when I presented chapter 13, the at-risk basis and the PAL limitations. So guaranteed payments, we said partners do not receive a W-2. They're not salaried employees, they're owners. And so we may have a managing partner who wants to, of course, get paid, compensated for their services. And so we're going to call these payments guaranteed payments. So the partnership is not going to be responsible for paying payroll taxes on these guaranteed payments, just like they would for an employee. They're just going to distribute this cash to the partner, and the partner will be responsible for paying self-employment tax on these guaranteed payments. And on the same token, the partnership gets to deduct the guaranteed payments as a deduction against ordinary income. Okay, so we have an example here. We have a 20% partner of the DJ Real Estate Partnership. He receives $1,000 per month for his services. This $1,000 per month is guaranteed payments, and it will be subtracted in deducting ordinary income at the partnership level, but it will also be included as a separately stated item on the Schedule K1 to the partner. I think someone asked about depreciation, if this was a separately stated item, and I think I already responded that only Section 179. And we're going to see how this comes into play later on. Partner health insurance premiums, this is going to be stated separately on their Schedule K1 because they're going to have to pay taxes on these premiums. There's also a business interest expense limitation. This is under the new law that was enacted in 2017-2018. So this applies to businesses that have annual gross receipts of over 25 million. So this would be the average of the 3 years. That's how this 25 million is calculated. And the interest expense is limited to 30% of the adjusted taxable income. We're not really going to go into this this term but this is just FYI. Okay, so skipping. Just keep in mind that for the partnership, although they don't pay taxes, they're still required to complete or file a Form 1065 with the tax authorities. Okay, and what the tax authorities are going to do is try to match what's reported on this Form 1065 against what the partners are reporting on the page 2 Schedule E and their Form 1040, and different aspects of the separately stated items. Okay, so as a general rule, all income and expenses are treated differently at the partner level, then it must be separately stated. So what we're talking about are things like portfolio income, so interest and dividends and capital gains and losses, which are going to receive a special treatment at the individual level. Could be rental property because of passive loss limitations. All that needs to be separately stated. So we already show this table 14-1, and you had a good breakdown of separately stated items, and we say these are not going to be included when calculating ordinary income or losses. Except for, of course, the guarantee payments, right? So again, the partnership gets to deduct the guarantee payments, but the partners are going to add it to their income on the Schedule K1. So that would be the only exception where you have an expense that was deducted against ordinary income and then also listed as a separately stated item on the Schedule K1. Okay, so we talked about the Schedule K1. There's also the qualified business income deduction. This is also under the new law, and as we know, it's gonna apply, allow a deduction of 20% from ordinary income. Okay, now, so we said that each partner will be responsible for paying their own self-employment tax. The partnership is not gonna withhold payroll taxes and be responsible for paying the payroll taxes on their behalf. So in order to do that, we need to assess or see how do we calculate the self-employment income. So basically, we take, if this is an active partner in the partnership, we're going to take the ordinary income that was reported on the Schedule K1. So this is the partner's share of income in that partnership. This partner is an active participant of this partnership. So they were paid guarantee payments. They received guarantee payments. So this will also be added in calculating self-employment income. If they had any Section 1231 gain or losses, they will be added or deducted here. In this case, they did not, but they did have Section 179, and we said Section 179 was a separately stated item on the Schedule K1. So they get to deduct their portion, their share of that Section 179 deduction to arrive at their self-employment income. So this is the starting point for our self-employment calculation, self-employment tax calculation. If you recall, we take this amount and we multiply it by 92.35%, right? Following the calculation on the Schedule SE. And then after that, we will multiply that by 15.3%, unless, we always have to be looking for the Social Security wage cap and that limitation, observe that limitation even in this situation. Okay, so we move on to learning objective 4, which is related to the basis of the partner on this partnership interest. And we sort of looked at this in chapter 13 as well. So this is, excuse me, sort of a review. So we begin with the tax basis of the property contributed. If we contributed services to the partnership in exchange for a partnership interest and we pay taxes on that, then that will be added to the basis. We will also, of course, cash will be also added. So cash or property that we contributed upon formation, our share of our ordinary income, our share of positive separately stated items, and if there's any partnership liabilities, these will also be added to the basis. Okay, and we looked at that in chapter 13. And then, of course, if we were distributed any monies or property, these will be subtracted from our basis. Ordinary losses, negative, separately stated items or expenses will also reduce our basis, and any release of liabilities will also reduce our basis, as we looked at in previous examples. Okay, so we have a couple of examples here. We have Allison has a basis of 5,000 in a partnership. She received 3,000 cash contributions and 2,500 in ordinary income and some other items. Okay, so the first thing that we need to do is let's calculate her basis without consideration to the distribution. So the distribution will be the last item that we're going to consider. So we have for basis, we add her share of income, ordinary income. There were no separately stated items. If they were, then we will also include them in this calculation. And then we subtract the distribution. Now note for the property distribution, we are using the adjusted basis, not the fair market value, in calculating the partner's basis. So we ended up with a positive basis, so it did not trigger any gain on the distribution. In this other example, we also have separately stated items so that you can see the interplay. How is that going to affect their basis? So we can see that positive separately stated items will increase our basis. Deductions and negative items will reduce our basis. Okay. Okay, so if we, like I said, if we receive a distribution of cash or property, there is no gain or loss. However, if the distribution exceeds basis, so in our previous example, if we were to receive a distribution of $80,000, which is in excess of the $71,595, then that excess, that negative basis, we will have to recognize and as a gain on our tax return. Okay, so this gain is only recognized when we receive money or marketable securities, and this distribution may trigger a pre-contribution gain. We don't need to worry too much about this pre-contribution gain that has to do with appreciated property. We'll just put a pin on that and maybe come back to it later. Okay, so the basis is also used to assess the capital gain or losses generated when we sell our interest in the partnership, okay, or the partnership liquidates. Okay, so that's pretty much everything that you need to know about partnership. The assignment will be posted in Connect. If you have any questions, just remember to use the course Q&A, and also to comment and pose your questions in regards to this video.